Hello, 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 and welcome to Woody's Weekly Wisdom, episode number 22 already. And today we're looking at this headline: Cost of living pressures laid bare in ABS household spending report. Now, before you switch off and think this is all going to be about cost of living and inflation and interest rates, hold your horses. Because this one's a little bit different. Although the headline is talking about cost of living pressures, this one is actually going to highlight something really important when it comes to smart investors. And I know you're all smart investors, so this one is aimed for you. And this one is actually going to give us a hint about where we should be putting our money when it comes to the stock market. So, as I said, when I first started these, we want to find the news behind the headlines. And this is a really good example of how we can use a bit of a story to actually tell us something that this article has no idea that it's telling us, but it's great for those smart investors out there. And this is where we can use the media for some hints. I don't necessarily suggest that we always do this, but for those people who are looking for hints in what's happening in the economy and the markets, well, here's an article that inadvertently, I believe, is telling us where we could be putting some of our money when it comes to the stock market. So, cost of living pressures laid bare in Australian Bureau of Statistics Household Spending Report. So the headline, I guess, or the first part of the report says that we spent more, as Aussies spent more in the year to May. And then but we held back on discretionary items. So here's the first little tip about where we're going with this article. We held back on discretionary items. So everyone across the world, it's not just Australians, everyone across the world is battling with the cost of living crisis, with all these items going up. But the first thing that people cut back on are the non-essentials. So things like furniture and clothing. There's another hint. And so, this report talks about overall household spending was up 3.3% in May compared to the same time last year. So that on its own suggests inflationary pressure, inflation is going to continue to go up, all those types of things. But it also was the slowest growth since July 2021. So then you've got, well, maybe there's some relief ahead. And then it says discretionary spending was down 0.6%. So we've got, some things going up, some things going down when it comes to our spending. And, it says in response to, head of business indicators, Robert Ewing says its response to increasing cost of living pressures. Well, no shit, Sherlock. And driving the fall in discretionary spending was 4.8% less spending on furnishings and household equipment. There's another hint. And 3.4% less on clothing and footwear. Another hint. And we just scroll down, we see all the graphs, exciting graphs that help make the article look great. And it's a very short article, basically saying that we've stopped spending, or we've certainly slowed down our spending on discretionary items. So what does that mean? Well, if you're a stock investor, and if you haven't got my How to Invest in a Downturn ebook yet, you need to hit the buttons below. I'll put a link available for you to get my book, How to Invest in a Downturn, because here is what's ahead for us over the next 18 months, maybe even 2 years. As all these inflationary pressures and interest rate rises start to bite the household spending, then what's the first thing that stops? And that's the discretionary stuff. So it might be home improvements, so the furnitures, or new clothing. So rather than getting the new releases, people start using last year's clothing, whether it's winter or summer. They'll use it again the next year because it's discretionary. It's not something that they absolutely have to spend. And so what does that tell us? Well, that then tells us that those companies that sell discretionary items are going to have depressed or declining sales growth rates, and therefore their stock price will be under pressure. So as a smart investor, you're looking at that and saying, well, okay, if I'm looking for capital growth over the next 12 to 18 months, it's probably not coming from those companies that sell discretionary items. And that's a really important insight into what's going on over the next 12 to 18 months in terms of your stock portfolio, especially if you're constructing it from now. So you're just starting to build it now and you want some capital growth over the next 12 to 18 months, who wouldn't? Then you need to be thinking about the companies that are going to do well in a downturn. And so, as I said, if you want a copy of my book, How to Invest in a Downturn, I'll leave a link down below and you can click on that and get access to that book. And it talks about exactly this point, the types of industries that are going to do well in a downturn and those that won't do so well. And like I said, if you're constructing your portfolio now and starting to add some individual stocks to your portfolio now, then you probably don't want to be adding companies that specialize in discretionary items, because that is where everybody is cutting back on their spending. So therefore less growth, less profits, less growth in the share price. So as I said, this article is just giving us some cold hard facts about what's happening with cost of living pressures, and inadvertently it's telling us what's going on or going to be going on in the stock market and what's a good investment versus a not so good investment for a smart investor, pardon me, at this time. With 12 to 18 months of more of these types of pressures still to filter through in terms of the household spending and the economy in general. Doesn't matter if you're in Australia or overseas, the same things are going to be happening. People are going to be cutting back on those discretionary items. We all still have to spend on food and those types of things that sustain us, but those things that can be put off, things like new cars, new home furnishings, new clothes, those types of things can all be put off. And so when people are looking at where do they make cutbacks to meet these rising interest rate payments and rising food costs and things like that, they cut back on those discretionary items. And so all we're seeing here is exactly what we would expect in a market where times are tough, and that's what we're seeing. So I've just highlighted that graph of household spending across the different states of Australia. If you're not in Australia, it doesn't really matter. The key point here, if we go up even higher to this graph, which is about household discretionary versus non-discretionary spending, then that shows you that we're starting to see discretionary spending to decline, and even non-discretionary is declining as well, which is interesting because it just means people have got less and less to spend. But the thing is that we're seeing, well, that's actually growth rates. So it's not surprising that they're shrinking in percentage terms, because there's just less money available because it's all been chewed up on mortgage payments. So, like I said, the message behind the message is that discretionary spending is being eased or is slowing down, and that will have a flow-on impact to the profits of those companies and therefore their stock prices. So as a smart investor, you have the opportunity to take advantage of that piece of information and say, I'm going to direct my funds to those companies that are going to perform well in a downturn. So, as I said, if you want to know more about how to profit and grow your wealth in a downturn, click on the link down there and get access to my book, How to Invest in a Downturn. Lots of great tips in there and more explanation of this point, which is highlighted in this article. Like I said, inadvertently, but it's in there, and we should take advantage of it. So hopefully that's helpful. Like I said, it's just a short article and one hopefully less about, like I said, less about interest rate rises, which has been a huge focus recently, and more about how you can take advantage of what we're starting to see in the economy as a smart investor to grow your wealth in a downturn. So click the link down below. If you're watching this on YouTube, make sure you subscribe to the channel and hit the notification bell so that you get notified when we're releasing something. And if you're watching this on Facebook, do me a huge favor. At least like, comment, or share, or do all three so that we can make sure more people are seeing these videos and getting these insights so that they can be a smart investor just like you. Have a great week. We'll see you again next week. Cheers.